Hello everyone. So in today's lecture we are going to discuss about basics of accounts, or we can say fundamentals of accounts. Let us assume there is one particular business, or there is one shop, and this is the person who has started this particular business. A person who is going to start the business is called as owner, and the other person is going to be called as business. So both owner and business are persons, but owner is called as a natural person who has got a natural birth, but business is going to be called as artificial person. Artificial means we have created it, it is man made. So there are two persons are involved. One is natural person who is an owner, and the other one is artificial person, which is a business. Now there is one important rule in accounts, that is, whenever you do accounting you should always and always think from business point of view. Whenever you learn this subject you always think from business point of view. What is happening in the life of the business, that you need to consider. What changes are happening in the business, that we need to consider. So whenever we do accounting we should always think from whose point of view? Business point of view. And don't think from owner's point of view. What is happening in the life of the owner is not considered in accounts. So what changes are happening in the life of the owner we don't consider. We consider only those things which is happening in the business. So whenever we do accounting we always think from whose point of view? Business point of view. Yes. Now one doubt will arise, sir, what is the purpose of learning this particular subject? Why we are learning this account subject? There are two main intention, two main objectives, purpose of learning this particular subject. One is to know the financial performance of the business, that is how much profit or loss made by the business. See, it's just like performance of the student is pass or fail. Same way the performance of the business, financial means in money terms. What is the performance of the business? Is that business has made profit or is it business has made loss in a particular period or in a particular year? So one of the main objective of accounts is to find out, is that our business has made profit or loss during a particular period. So this is called as financial performance of the business. Now, sir, how to find the profit or loss of the business? See, it's very simple. Let us assume that I am running one particular academy, coaching classes. Whatever the fees I collect from the student, whatever the money I collect from the student as fees, that is my income. But whatever the fees I collect from student, entire amount I cannot keep in the pocket, because out of that fees collected I need to pay the rent, I need to pay the salary to teaching staff, non-teaching staff, I need to pay maintenance charges and all, electricity bill, water bill. So after deducting all these expenses, what are the remaining amount is being left out, that is going to be called as profit. Let us say totally I collected 10 lakh rupees as a fees from the student, and out of that let us say 6 lakh rupees I paid as rent, salary, electricity bill, water bill and all. So 10 lakh minus 6 lakhs, I am left out with 4 lakh. This 4 lakh is called as profit. Suppose assume that my income is 10 lakh but expenses are 12 lakhs. My expense is more than the income, then it's going to be called as a loss. So if your income is more than the expenses, it is called as profit. If your expenses are greater than the income, then it's going to be called as a loss. So first main intention of this particular subject is to find out profit or loss made by the business. Next, the second objective is to know the financial position of the business. Sir, what is my financial position? Financial strength of the business. How how much our business is financially strong. Let us take one example. Let's say one of your neighbor is having a total assets of, let us say, 100 crore rupees. Total properties or total assets of 100 crore rupees. Let us say he's having bungalow, he's having some Mercedes car, some supercars, some gold, ornaments, diamond ring, and all those things. Let's say the total worth of that properties or assets is 100 crore rupees. So once you find that that person is having a total properties of worth of rupees 100 crore, you cannot call him as a rich person. To identify is he financially strong or not, we are not only supposed to see the total assets of that person. Along with his total assets, even we need to see his total liabilities. On that 100 crore rupees of whatever the assets is having or property is having, let us say he has taken a loan from the bank to buy those assets, to buy those properties. Let's say 99 crore rupees of loan he has taken from the bank. And 1 crore rupees he has invested from his pocket. So 1 crore plus 99 crore. So total 100 crore. And with the help of that 100 crores, he has bought an asset or properties of 100 crores. So it means that that entire 100 crore rupees doesn't belong to that person. Because out of that 100 crores, 99 crore rupees he has borrowed from outsiders, from bank, which he has to repay in future. That is called as liability. The amount which he has to do repayment in future is called as a liability. So out of his total 100 crore rupees, 99 crore rupees, so he has to do repayment in future to the bank. Only remaining 1 crore rupees belongs to him, what he invested from his pocket. That is called as capital. So what you invest from your pocket is going to be called as capital. What you borrowed from outsiders is called as a liability. So 1 crore rupees I invested. I means owner has invested 1 crore. That is called as capital. 99 crore rupees I borrow from outsiders. That is going to be called as bank loan, liability. And 1 plus 99 crores. Total of 100 crore rupees I bought assets, properties. Properties are called as assets. So this second objective is to know the financial position, financial performance of the business. How much our business is financially strong. So to know somebody's financial strength, you should not see only total of his assets. From the total of assets, you need to minus total of its liability. 100 crore minus 99 crore is equal to 1 crore. This 1 crore is called as capital or net worth of the business. That's the reason you might have seen this in the newspaper. They say that Elon Musk has a net worth of this many crores, or Mukesh Ambani has a net worth. They use the word called as net worth. That is total of asset minus total of liability. So to judge the financial strength or financial position of the business, you need to see his total net worth. That is total of asset minus liabilities. So the two main objectives of learning this subject is, one, to know the financial performance, how much profit or loss made by the business. And one more is to know the financial position, financial strength of the business, how much financially our business is strong or weak. That is financial position of the business. So whenever we do accounting, we always think from whose point of view? Business point of view. We don't think from owner's point of view. We always think from business point of view. Our intention is not to find out personal profit or loss of the owner or financial position of the owner. Here we are interested to know the financial performance and financial position of the business. If you want to find out the profit or loss of the business separately and profit or loss of the owner separately, then keep personal expenses and income separate from business income and expenses. So if you want to know only the profit or loss of the business, then business income and expenses should be kept separate from personal income and expenses. So conclusion is, you should always think as if you are an accountant of the business. Don't think that you are an accountant of the owner. Don't think as if you are an accountant of the owner. You always think that you are an accountant of the business. So you record only those things what is happening in the business. So conclusion is, treat business and owner as two separate person. We have to, whenever we do accounting, we should always think business and owner as a two separate person. Business is completely separate and owner is completely separate. Then only you will be able to find out profit or loss of the business separately. So this particular rule or condition in accounts is called as business entity concept. In accounts, there are some set of rules on which entire accounting is based. Those are called as accounting concepts. Accounting concept means a set of rules. It's not a single rule, a set of rules on which entire accounting is based. So one of that rule is called as business entity concept, which says that business and owner should be treated as two separate person. So this is your concept number 1, which says that treat owner and business as two separate person. Hello everyone. In the previous lecture, we discussed that we do accounting so that we can find out financial performance. Financial performance means profit or loss made by the business. And financial position, financial strength or financial weakness of the business. So if you want to know the profit or loss of the business, we need to keep a record of income earned during the year by the business. What all incomes are made by the business during the year and what all expenses are incurred in the business. And if you want to know the financial position, financial strength of the business, you need to know the assets of the business and liabilities of the business. So basically in accounting, we have to do recording of business information. If you want to know profit or loss of the business, you need to keep a record of incomes and expenses of the business. So what do you mean by accounting? In accounting, we do recording of business information. Now you need to understand that each and everything what is going to happen in the business are of two types. Whatever the things which are going to happen in the business are of two types: quantitative information and qualitative information. Both informations are related to business, but some informations are measurable in terms of money and some other informations are not measurable in terms of money. So each and everything what is happening in your business are business information. In that we have two types: measurable in terms of money, which are called as quantitative information, quantifiable, measurable in terms of money. And some informations are not measurable in terms of money. Those are called as qualitative information. See examples of quantitative information: goods purchased. We purchased goods in the business. Goods sold. Goods purchased for rupees 2 lakhs. Goods sold for rupees 4 lakhs. These all are quantifiable. These all are called as quantitative information because they are quantifiable in terms of money. For example, shop electric charges paid 1000, 2000, 3000 rupees. Salary paid to staff. Shop rent paid. So these all informations are called as which information? Quantitative information, because they are measurable in terms of money. Next, qualitative information. Those informations which relates to the business, but they are not measurable in terms of money. Those informations which are important for the business, which make an impact on the performance of the business, profit or loss of the business, but still they are not recorded in the books of account. Why they are not recorded? Because they are not measurable in terms of money. For example, employee skill. To run a business, let us say you have kept some employees. Those employees are very skillful, very talented, very hardworking. So obviously it will make an impact on your business. Your profitability will get affected due to that. But when you find out the profit or loss of the business, don't consider this into consideration, into the calculation, because they are not measurable in terms of money. Quality of management team. Management means a set of people, professional people who run the organization. You can say board of directors of the company. So if they are very skillful, very qualitative, very efficient management team you have, it will make an impact on the performance of the business. But while calculating profit or loss of the business, we don't take this into consideration because they are not measurable in terms of money. Let us say dispute. Let's say in your company you have, in your business you have one production manager who produces the goods, sales manager who sell the goods to the customer. So what will happen? Sales manager will take an orders from the customer, and sales manager has to give that information to the production manager to do the production of the goods. Now let us say there is a dispute between these two people, production manager and sales manager. They are not communicating to each other properly. Then what will happen? What are the orders you are getting from the customer? That information sales manager may not provide it properly to production manager. So production manager will not produce the goods. So if you don't produce the goods, then how you deliver to the customer? So if you have any dispute between these two people, even that also it's going to impact the business, profitability of the business. But you cannot record it in the books of accounts. You cannot keep a record of it because they are not measurable in terms of money. Employee strike. Let us say employees went into strike. They are not doing any kind of work at the time of strike. But that employee strike, that particular thing, you cannot record it in terms of money because these are qualitative things. Quality, like beauty, honesty, dishonesty, these all are qualitative things. We cannot measure in terms of money. So in accounts, what do? We do recording of business information. So is it like every business information is going to be recorded? No. We keep a record of only quantitative informations which are measurable in terms of money. So only quantitative informations are recorded. We don't record qualitative informations because they are not measurable in terms of money. Not recorded. Yes. Now listen. Every quantitative information, it means those informations of the business which are measurable in terms of money, are going to be recorded in the books of accounts. And every quantitative information of the business are called as business transaction. So in accounts, we do recording of business transactions. Business transaction is those things which are related to the business, which make some impact or changes in the business. plus they are measurable in terms of money. So qualitative informations are not called as business transactions. Only quantitative informations are called as business transactions, which are related to business, plus they are measurable in terms of money. So conclusion of this concept is what? We keep record of only quantitative information, quantifiable informations. And this particular rule in accounts is called as money measurement concept. Money measurement concept says if anything is related to your business, if any information is related to your business, you can keep a record of it, provided it should be measurable in terms of money. Suppose if there is any business information which is most important for your business, but it cannot be measured in terms of money, then don't record it. Record only if it is measurable in terms of money. So this particular concept, this particular rule is called as money measurement concept. Hello everyone. So now we are going to discuss about concept number 3. So in the previous lecture we discussed that all those informations which are related to the business, all those business informations which are measurable in terms of money are called as business transaction. Those informations related to business and which are measurable in terms of money are called as business transaction. For example, sale of goods for cash. You sold goods to the customer for cash. This is a business transaction which can be measurable in terms of money. Purchase of goods for cash. So all these are examples of business transaction. Now you have to understand that every business transaction is going to make two changes in the business. What do you mean by two changes? For example, let us assume you sold goods for cash. You sold goods to the customer for cash. Think from business point of view. Business has sold the goods. It means goods are going out of the business. And we have collected the cash from the customer. So cash is going to come into the business. So goods are going out and cash is coming in. So it means that this transaction made two changes. One change in goods and the other change in which one? Cash. For example, purchase of goods for cash. You purchased goods from the supplier and you paid cash for that. So when you buy the goods, what will happen? Goods will enter into the business and cash will go out. So even here also there are two changes are happening in the business. So we say that every business transaction is going to make some changes in the business. And it will make how many changes? Two changes in business. This particular concept is called as dual aspect concept. This particular rule in accounts is called as dual aspect. We say every business transaction has two aspects in it, two changes in it, dual, double. So this is called as dual aspect concept. Now you understand that what are the two changes a business transaction is going to make in the business, that we can classify into 5 categories. So whatever the changes will happen in the business, that you can classify it, that you can name it into 5 things. So those 5 things are, first one is an asset. So whenever any business transaction happen, assets of your business may change. It may increase or decrease, or expense of your business may change, increase or decrease, or incomes of your business, liabilities of your business or capital of your business will change, will increase or decrease. So what are the two changes a business transaction is going to make in the business that can be classified into any of these five category? So if a business transaction has happened, it means out of five things, something would have changed in the business. Either asset, expense, income, liability, or capital would have changed in the business. These are the most important five terms of accounts which we need to understand. Now, what are these five items are there? We can group into two activities, or we can group into two categories. Two groups we can do for these five items. One group is for asset and expenses. Asset expense will come in one particular group, and income, liability, capital will come in the second group. So first group is for asset expense, and next group is for income, liability, and capital. Now understand how I have done the grouping of these two things. Why asset expense will come in the same group, income, liability, capital will come in the other group. See, listen. Whenever you buy an asset, whenever you buy any property or any asset, for example, building purchased, machinery purchased, furniture purchased. So if you buy any asset for your business, money will go out of the business. There is an outflow of money. Whenever you pay any expenses, for example, salary paid, rent paid, electric charges paid. So there also what is happening? There is an outflow of money from the business. So in both these cases, you can find that one thing is common, outflow of money. You buy asset or you pay expenses, one thing is common, there is an outflow of money. But if you find in these three things, income, liability, and capital, one thing is common, that is there is inflow of money. For example, fees collected from the student, college fees or tuition fees collected from the student. So for me, it's an income. There is an inflow of money. I'm collecting the fees from the student. It's an income, inflow of money. Let's say I went to the bank, I took a loan of 10 lakhs. What are the 10 lakh of loan I taken from the bank? For me, it's a liability because I need to repay in future. So when I take the loan from the bank, even here also money is coming into business. There is inflow of money. Next, let us say there is one particular business and owner has invested the money into the business. So if you think from business point of view, there is inflow of money. Money is coming into the business and this money is being introduced or invested by the owner. So this is called as capital. Money invested by the owner into the business is called as capital. So here also there is inflow of money. So in these three cases, one thing is common, there is inflow of money. And in these two cases, one thing is common, there is an outflow of money. Hello everyone. So now we are going to discuss about these five terms: asset, expense, income, liability, and capital. So we'll try to understand what is the meaning of each of these five terms. So first we'll try to understand what do you mean by asset and expenses. Now, before we understand these two terms, asset and expenses, few more things you need to understand first. Now listen, for an example, assume that you have started one new business. Let us say one mobile showroom business you have started, or any one stationery business you have started. Now, normally whenever you start with a new business, you start with an intention that you are going to run that business for a long period of time. Suppose if you have started the business today, it's not like you're going to close down that business. after 1 6 months or after 1 year or after 2 years you're going to close down. No, you're not going to do like that. Normally whenever we start a business, we think that we are going to continue this business, we are going to run the business operations for a very long period of time. This is an assumption we keep in our mind when we start a business. Assume that at the age of 20 you have started one particular business and you're planning that you're going to take retirement at the age of 60. So 20 to 60, it means that approximately you're going to run the business for a period of 40 years. So this 40 years is a long period of time. It's an assumption that you're going to run the business for this many number of years. So this particular assumption, this particular rule or this particular concept in accounts is called as going concern concept or going concern assumption. It's just an assumption. We don't know actually what is going to happen. Maybe possible the owner may die at the age of 30, 35, 40. Anything can happen. But it's just an assumption that we are going to do business for a long period of time. So this particular concept is called as going concern concept or going concern assumption. And even you can take an example like this. Even I am also taking the lecture, I'm into teaching, I'm earning the money. The intention is that the intention of earning the money or why I'm earning the money because I'm assuming that I'm going to live for a long period of time. But there is no guarantee in the life that a person will live for a long period of time. These all are just assumptions. Even being a student, you're learning this subject, you're learning this particular subject. So you're assuming that you will live for a long run and in future this account subject may help you to do some job in the company, some accounting job in the company. So these all are assumption that we are going to live for a long period of time. So same thing is applicable in business, that business will be continued for long period of time. This is called as going concern concept or going concern assumption. Now listen, if you are running the business, then obviously you will be interested. Being a owner, you will be interested to know how much profit or loss your business has made. So if you want to know the profit or loss of your business, you will not wait for all the 40 years to complete. Sir, after 40 years, I will see how much income has happened in these 40 years, how much expenses incurred in these 40 years. Then I'll calculate profit or loss after 40 years. No, nobody will wait for 40 years to know the profit or loss of the business. So what we do is, whatever these 40 years of life of the business is there, we divide into pieces. We do split, we do partition, and each partition is usually of 12 months. So whatever this life is there of 40 years, we do partition of this. And each partition, we usually keep it for how many months? 12 months. So that for each of these 12 months, we can find out the profit or loss made by the business. Every 12 months, separately we calculate, have we made profit or have we made loss? And one more thing, there is no rule that you need to keep each time period or each partition for 12 months. You can keep it for 9 months also, 10 months also, 13 months also, 15 months also. There is no problem. But usually people keep a time period of how many months? 12 months. So that you can measure, you can know the performance, profit or loss of the business. This 12 months can start from 1st April and end on the 31st March. 12 months. April to March, 12 months. So if you keep April to March, then we call it as financial year. If you keep from 1st January to 31st December, then we are going to call it as calendar year. January to December, again 12 months. And there is no condition that you need to keep only April to March or January to December. Any 12 months you can keep. Any 12 months you can keep as an accounting period. Let us say from 1st October to 30th September. 1st October to 30th September, again 12 months. 1st July to 30th June, again 12 months. Any 12 months can be kept as an accounting period. And this particular rule, this particular concept in accounts is called as accounting period concept, or you can call it as periodicity concept. Accounting period concept, or you can call it as periodicity concept. Which says that if you want to measure the performance, profit or loss of the business, whatever the life of the business is there, you make partition of that. Each partition should be for 12 months. And this concept is called as accounting period concept. Yes. So now we can understand what do you mean by asset and what do you mean by expense. So first I will explain you these two terms. Now listen. You just understand that asset means unexpired cost or unexpired benefit. The cost which is not yet expired, the money which is not yet expired, the benefit which is not yet expired, which is unexpired, is called as an asset. If the cost or money or benefit is already expired, then it is going to be called as expense. Expense means expired, asset means unexpired. Now try to understand these two things with an example. Let us assume that our year is going to start, our accounting period is going to start from 1st January 24 and it is going to end on 31st December. 1st January to 31st December 2024. This is our current accounting period. Next year is going to be 25, 26, 27, 28, like that. Now, whenever I say expense, expense means benefit expired or cost expired in the current accounting period. In this 12 months, whatever the benefit is being expired, that much portion, that much money value, or that much of cost is called as an expense. Uh, Suppose if any money which you have paid or any cost which you have paid, the benefit of which is not yet expired in this current 12 months, which is still unexpired as on 31st December. Till 31st December, it is not expired, it is still unexpired, for which you going to get the benefit in future, which will get expired in future years, but not in current year. Then this particular portion is going to be called as an asset. So, which is expired in this 12 months in the current accounting period is called as an expense. Which is not yet expired in the current accounting period and for which you will get benefit or which will get expired in future accounting period, then it is going to be called as an asset. Let's take an example. Let us on 1st January 24. On 1st January 2024, you kept one person on employment for a salary of 10,000 rupees per month. And assume that that worker has worked for 12 months. that particular person, employee, has worked for how many months? 12 months. So 10,000 into 12, you have to pay 1,20,000 rupees to him. So on 31st December, year end date, you have to pay to that employee how much rupees? 1,20,000, because he has worked for 12 months. But assume that you have paid 1,50,000 rupees. Instead of 1,20,000, you have paid 1,50,000. Now why you have paid 1,50,000? 1,20,000 to 12 months salary. 3 months salary you have paid in advance. Let us say 2025, January, February, March. 3 months salary you have paid in advance in the current year only. So employee was saying that, sir, I have some financial problem. I'm in requirement of money. So please pay me some extra money in advance. So in the current year only, on 31st December itself, assume that you have paid 1,50,000. Now out of this 1,50,000, for 1,20,000, benefit is already expired in the current year. Business has already consumed the benefit, has already received the benefit of 1,20,000 in the current year. That much of benefits already expired in the current year. So this 1,20,000 benefit which is already consumed or expired in the current year is called as an expense, and name of that expense is called as salary. Now out of this 1,50,000, 30,000 rupees of benefit is not yet expired, not yet consumed. 30,000 rupees of benefit is not yet expired in the current year. It is not yet consumed in the current year, which is still unexpired, for which you will get benefit in next year, 2025, January, February, March. For that 30,000 rupees, worker is going to work for 3 months in the next year. So on year end date, it is still unexpired. Then that particular portion, this 30,000 of rupees, is called as an asset. And in accounts, the name of that asset is called as prepaid salary. Prepaid salary is a name of an accounts. Sorry, name of the asset. In accounts, we call it as prepaid salary, which is an asset. So I hope you have understood. Benefit which is expired in current year is expense, and which is not yet expired in the current year, for which you will get benefit in future, it is going to be called as an asset. Let's take one more example. Let us assume that you have bought one car, you have purchased one car on 1st January 2024. On 1st January 2024, you purchased one car. Let us say for a price of rupees 5 lakhs. And life of this car is 5 years. So you purchased one car for 5 lakh. Life is how many years? 5 years. So it means that what of this 5 lakh rupees you have paid for the car, it is going to be benefit for your business for 5 years. 24, 25, 26, 27 and 28. Now, once this 1 year is going to get completed, once you reach to the end of the current year, you need to find out of that 5 lakh rupees how much is expired, how much is unexpired. Because expired is called as an expense, and unexpired portion is going to be called as an asset. So if 5 lakh rupees is being paid for 5 years, then each year approximately we have taken a benefit of 1 lakh rupees. 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh. So totally for 5 years we have taken a benefit of how much rupees? 5 lakh. So out of this 5 lakh rupees, by the end of current year, 1 lakh cost is being expired. 1 lakh benefit is already consumed over. That much portion is called as an expense. and name of that expense in accounts, we call it as depreciation. Depreciation. And beyond that current year, how much benefit you're going to get in future? 4 lakhs. So beyond current year, you'll get a benefit of rupees 4 lakh, which is still unexpired in the current year. By the end of current year, still it is unexpired. So that particular portion is called as an asset. And the name of that asset is called as car. So I hope you have understood what do you mean by asset and what do you mean by expense. Now one doubt will arise, sir, whenever you find out how much is expired or unexpired, when do we need to check how much is expired or unexpired? You need to always check on year end date. Whenever your accounting period is going to end, on that date you need to find how much is expired and how much is unexpired. Because on year end date we find profit or loss of the business. So if you want to find profit or loss of the business, you need to do income minus expenses. So this how much expense is there, that you need to know at the end of the year, because profit or loss also is also found out at the end of the year. And even we know the financial position, financial strength of the business on year end date. So on year end date, we need to know what is the assets of the business, what's the liability of the business. So asset liability details also you want on year end date to know the financial position of the business. So whenever you do the classification of expired or unexpired, that you need to do on year end date. Now in this, you understand last one concept. See, listen. There is one more concept called as accrual concept. There is one more concept called as accrual concept. Now see, listen, what do you mean by accrual concept? See, if you take an example of this car, I purchased one car on 1st January 2024. And how much amount I paid for this? 5 lakhs. Out of 5 lakh, what are the money you have paid? How much is expired in current year is 1 lakh. 5 lakh divided by 5, in the current year how much expired is 1 lakh. And this 1 lakh is going to be called as an expense. And this is expense of which year? First year. Next, in second year, out of 5 lakh, how much will get expired? Again 1 lakh. So again 1 lakh is an expense of second year. One more 1 lakh rupees is going to expire in the third year. It's an expense of third year. In accounts now, there is a concept called as accrual concept. Accrual concept says that when you make the payment of money is not important. When we do the payment of money, money paid in which year is not important. In which year you took the benefit of that particular money, that is important. In which year you took the benefit of that particular money, that is important to find out is it an expense of that year or not. See, for example, in this second year you have not paid any money, but second year we are saying 1 lakh is an expense. But have you paid any money, 1 lakh rupees in the second year? No, because full 5 lakh rupees so we have paid in the first year only. So you may pay the money full 5 lakh in whichever the year you want. There is no problem. But full 5 lakh cannot be treated as expense of first year. In which year you took the benefit of that money, that is important. In that year, it will be regarded as an expense. So even you have paid full 5 lakh rupees in the first year, out of this 5 lakh, we say 1 lakh is expense of second year, 1 lakh is expense of third year, fourth year, and fifth year. This concept is called as which concept? Accrual concept. So accrual concept means book an expense or record as an expense once it is being enjoyed by the business, once it is being consumed in the business, or once it is expired in the business. In whichever the year the money benefit is being enjoyed, is being consumed or expired, in that year it will be called as an expense and not in the year in which it is paid, and not in the year in which it is being paid. See one more example. Last one example. Same example I'll take. Salary of 10,000 rupees per month. Worker has worked for 12 months. So we have to pay 1,20,000. Now what has happened? At the end of current year, we have paid only 1 lakh rupees to the employee. We have to pay 1,20,000. He worked for 12 months, but we have paid only how much? 1 lakh. And we promised to the employee that remaining 20,000 we are going to pay in the next year. 1 lakh we paid in current year. 20,000 we are going to pay in the next year. Now listen. If someone is going to ask me how much is expense of current year, I will not say that it is only 1 lakh. Even I paid 1 lakh rupees in the current year, I will not call current year expense as rupees 1 lakh. I will say that current year expense is 1,20,000 rupees. Why? Because even though you have paid this 20,000 rupees in the next year, it is not an expense of next year, because the benefit of 20,000 you have consumed in the current year only. So this 20,000 what you paid in the next year, it's an expense of current year only, not an expense of next year. And even this 1 lakh what you paid, for this also you consume the benefit in the current year. So even this 1 lakh is also expense of current year. So 1 lakh plus 20, current year expense is how much? 1,20,000. So in short, how you need to understand, whatever the salary is there for this 12 months, how much ever the number of months the worker has worked in the current year, that much full amount is an expense. Let that 120 is paid or not paid, doesn't matter. Full 120 is an expense. Let us assume out of 120 nothing is paid in current year. Even then this 120 is an expense of current year. You may pay this 1,20,000 in the 2025, 26, 27, 28, doesn't matter. He worked in the current year, so it's an expense of current year, even though money is paid or not paid. This is called as accrual concept. Once you enjoy the benefit, once you consume the benefit, it's an expense of that year, even though the amount is paid or not paid. So see here also one more example. I paid 1,50,000 in the current year. But what are 150 I paid in current year? Full 150 is not an expense, because how much you consumed in current year? 120. Only that much is expense. Because remaining 30 is unexpired in current year. So at the end of current year, that 30 is unexpired. It's an asset. But next year it's going to become an expense because it will expire in the next year. So 30,000 will be called as expense of next year because it will expire in next year. Hello everyone. So now we are going to discuss about remaining three terms, that is income, liability and capital. And all these things we are going to discuss from business point of view: business income, business liability and business capital. So out of these three terms, first we are going to understand about income and liability. So let us understand with an example. Let us say, suppose I've taken some tuition classes for you, some accounting classes for you. And at the end of the classes, after the end of the syllabus or course, I've collected a tuition fees of 10,000 rupees from you. So I've received a money of rupees 10,000 from you. And let us say I went to the bank and I took a loan of 5 lakh rupees from the bank, which I need to repay in future. 5 lakh rupees of loan I taken from the bank. So here also what is happening? 5 lakh rupees is coming into the business, and even this 10,000 rupees fees which I collected from you, tuition fees, that is also coming into business. Now out of these two amount which I have received in the business, 10,000 is not money received from you, it is money earned from you. What are the 10,000 rupees I have collected from you? It is not just received from you, I have earned from you. And what are the 10,000 which I have earned from you? There is no obligation, there is no liability, there is no condition to do repayment in future. So income is money earned, not received. Money earned, and there is no obligation to do repayment in future. There is no obligation that I need to pay back that money in future. So the 10,000 rupees is going to be called as an income. Next, liability. Whatever 5 lakh rupees of loan I have taken from the bank, that is not earned by me. I have not made any efforts to earn that 5 lakh rupees. That is just received from the home bank, which I need to repay in future. So liability means money received, not money earned. It is just money received. And what other 5 lakh rupees I have received from the bank, there is an obligation to do the payment in future. So let it be in case of income or let it be in case of liability, one thing is common. What is that? Inflow of money. But whenever there is an inflow of money, income is money earned. I've earned the money, that is the reason I'm receiving. And there is no obligation to do repayment in future. But liability is what? Money received. And there is an obligation to do repayment in future. So this is how you are going to differentiate what is an income and what is a liability. So what you need to think, whenever you receive something, you check it out. Have you earned it or have you received it? And one more thing, you check it out. Is it you are liable to do repayment in future? If it is yes, then it's a liability. Otherwise, it's an income. So I hope you have understood what do you mean by income and what do you mean by liability. Now listen. Liability doesn't mean that only money received. For example, let us say you went to the supplier of the goods. You have received goods from him. You have received the goods from the supplier of the goods. And you promise that you are going to make the payment of this money in future. Whatever the goods you have purchased on credit. It means you are not paid the money. You are going to pay in future. So even goods received for which you have to do the payment in future is a liability. Let us say you wanted to buy one asset, furniture. You went to the furniture shopkeeper. You purchase that furniture on credit, saying that you are going to pay this money in future. even this is also a liability. So liability means you may receive money, you may receive goods, and you may receive asset, and you promise to pay that money in future. All those things are called as liability. So money or goods or asset received, and there is an obligation to do payment in future, then it's going to be called as a liability. So now we'll understand what do you mean by capital. Capital is very much similar to the liability. Same meaning. Meaning of liability and capital is similar. Only one difference is there. Liability means you're receiving the goods or money or asset from an outsider. Business is receiving the goods or asset or money from an outsider, and for which business is liable to make the payment in future to an outsider, then it's going to be called as liability. Suppose if same goods or money or asset, if you have received from the owner, suppose you are receiving the goods, you are receiving the asset, or you are receiving the money from the owner, even then also business is liable to make the payment of that money in future. Even then also business is liable to repay those things in future to the owner, because we follow which concept? Business entity concept. Business entity concept says that business is separate, owner is separate. When you have already treated business is completely different from owner, then whatever the money the owner has invested into business, whatever the money, whatever the asset, or whatever the goods the owner has invested into the business, for that business is liable to do repayment in future to the owner. So that particular portion is called as an capital. So what do you mean capital? Capital means money or asset or goods invested into the business by the owner. It is called as capital, and it is similar to the which one? Liability, because liability is also repayable in future. Capital is also repayable in future. Now doubt will arise, sir, if owner has invested anything into his own business, sir, it is his own business, why he has to get back that money from his own business, or why his own business is liable to pay that money to the owner? Because we have assumed that business is separate and owner is separate. We have taken these two people as separate. So if owner gives something to the business, business has to repay it. Or if business give anything to the owner, owner has to repay it in future, because of business entity concept. So conclusion is what? Liability and capital. Liability and capital, both are obligation to the business. Both are liable to be repaid in future. Both are obligation to the business. If it is to outside us, then it is called as liability. If it is towards the owner, then we call it as capital. So by this we have understood all the five terms. What all five terms? Income, liability, and capital. Now in this you understand one last term, last concept called as accrual concept, which I explained at the time of asset and expense. Same thing is applicable here. Accrual concept. Now see what accrual concept says. For example, let us say 10,000 rupees per month is the tuition fees or college fees. Let us say I have taken classes for you people for 12 months. In the current year, I have taken the classes for 12 months. So it means that I have to get 1,20,000 rupees from you. So in this current year, 12 months, how much is the tuition fees or how much I've earned from you is 1 lakh 20. Entire 1 lakh 20,000 which I've earned in current year, it's an income of current year. Even if I receive just 1 lakh from you and 20,000 I'm going to receive in the next year, even then full 1 lakh 20 is called as income of current year. So once you earn the money, it's an income of that year, even if that amount is received or not received. So whatever 1 lakh I have received in current year, that is earned in current year. And whatever the 20,000 I received in next year, that also I have earned in which year? Only current year. So both this 1 lakh plus 20,000 are earned in current year. So total income of current year is 1 lakh 20,000. Even if you receive 1 lakh. Or take one more example. Let us say that you have received 1 lakh 50. Instead of 1 lakh 20, you have received 1 lakh 50. 30,000 rupees I collected fees in advance. Tuition fees I have taken in advance from the student. But have I earned 30 in the current year? No. I might have received, but I have not earned 30,000 in current year. So 30,000 rupees is not an income of current year. Only 1 lakh 20,000 is called as an income of current year. So how much you receive in current year is not important. How much you earn in current year, that is important. So that is your income of current year. As per which concept? Accrual concept. So what you need to understand, once you have earned 120 in current year, how much ever you have received or not received doesn't matter. Full 120 is an income of current year. And same thing is applicable for expense. If 12 months expense are 120, salary 10,000 per month, he work for 12 months, 120. How much is paid? Even 1 lakh paid, expense is 120. Even 1 lakh 50,000 paid, expense is 1 lakh 20. Full 12 months expense. Don't take anything more than 12 months, less than 12 months. Take exactly 12 months expense, even it is paid or not paid. So at the end of the current year, whenever you find profit or loss of the business, you need to do income minus expenses. But whenever you take how much is your income, you take as per accrual concept. How much is earned in current year, received or not received doesn't matter. Minus you do expenses as per accrual concept. How much is expense of current year, how much cost is expired in current year, how much benefit is consumed in current year, even it is paid or not paid, that is an expense. So profit or loss is always calculated by taking accrued income minus accrued expenses. So this accrual concept is most important when you talk about income and expenses. Yes. So by this you have understood all the five terms. First one is asset. So asset means what? Unexpired benefit or unexpired cost. Unexpired benefit, or we can say unexpired cost. That portion of the expenditure which has not been consumed till the end of accounting period is called as an asset. In other words, it is unconsumed portion of the expenditure at the end of the current accounting period. Huh. What is unconsumed in current year, not expired in current year, will get consumed in future year. So now though we call it as an asset, but in future it will be called as an expense. So usually the unexpired cost becomes future expired cost. What is unexpired in current year, in future it will become expired. So example of asset is land, building, machinery, furniture, car, AC, etc. Next, we have understood what do you mean by expense. Expense means expired cost or expired benefit. That portion of the expenditure, that portion of the money spent or expenditure which has been consumed during the current accounting period. Again, now listen, just one more point. See, you people might have heard about expenses and losses. Both are similar, both are same, but there is a difference. Expense means utilized cost. Loss means lost cost. Here it is lost, here it is utilized. See, for example, let us say you bought a piece of cake, you purchased a piece of cake and you consumed it, you have eaten it. So, whatever the money you have paid for that particular piece of cake and which you have consumed, it is an expense because it's expired. Once you consume, once you eat it, it is expired. Take one more example. Let's say you purchased a piece of cake and you paid money for that. But that cake has fallen down. Let us say it is spoiled. Now you cannot consume it. Now what will happen? Even if that piece of cake has fallen down, it is being spoiled, you cannot consume it now because it is spoiled now. But still the benefit is expired. So you eat the cake or the cake is being spoiled. In both the cases, benefit is expired. But in first case, when you consume the cake, when you eat the cake, you have received the benefit of that. But in second case, you have not received the benefit. So expense are of two types: utilized and lost. Let it be utilized or let it be lost. One thing is common. Here also it is expired. Here also it is expired. But here you have enjoyed the benefit. Here you have not enjoyed the benefit. So utilized cost means it is that portion of the expired cost which benefits the business. Example: salary, rent, electric charges, depreciation. You're using the electricity, you're using the premises, you're using the services of the employee, you're receiving the benefit and you're paying the money. That's an expense. Lost cost, that portion of the expired cost. It is also expired only, but does not contribute to the benefit of the business. We not received any benefit, no contribution to the benefit of the business, but still the cost is being expired. For example, let us say you purchase one piece of cake, or let's say you purchase one car, and once you purchased it, it is destroyed due to fire. Let's say you purchase today, next day by end of the day or night or next day morning, it is destroyed by fire. Now what happened? You have not taken the benefit of that particular money what you paid, but benefit is already expired, cost is already expired, car is already gone, lost. So that is called as which one? Lost cost. That is loss of uninsured. If you have taken the insurance on that car, then what will happen? You will receive the value of that car from insurance company. Suppose if you have not taken any insurance, then what will happen? Entire money is being lost. You have not received any benefit and money is being expired. So that is going to be called as lost cost. Next, we have understood what do you mean by income. Income is money earned during an accounting period. We have earned the money during the current year and which is not refundable back in future. We are not supposed to repay back in future. It's called as an income. Tuition fees collected, sale of goods. I sold the goods to the customer. I received the money. What are the money I have received? That's my income. I have earned that money. I am not supposed to pay back that money to the customer in future. That is called as an income. Next, liability. Liability means what? Money received, goods or asset received during an accounting period, and which is refundable back in future to an outsider, where there is an obligation to do repayment in future to an outsider. For example, we took loan from bank, or we took loan from the friends. We have to make the payment in future, or we purchase some goods on credit from the supplier. For that, we have to make the payment in future. But liability is payable to an outsider. Same concept is capital. Money, asset, or goods received, and which is payable in future. There is an obligation to do the payment in future, but to the owner, is called as capital. Hello everyone. So now we are going to discuss about goods. We are going to understand what do you mean by goods. Let us understand like this. Anything which you are going to buy in the business, anything which you are going to buy, or anything which is bought in the business, either they are purchased with an intention to resell to the customer, or with an intention to use it in the business. Let us take an example. You have a stationery shop. You purchase some pen, pencil, marker, duster, notebook, test books, calculator, ink bottle. All these things you have purchased with an intention to sell it to the customer, to make resale to the customer. So anything bought with an intention to resell to the customer is going to be called as goods. Suppose in a stationery shop you purchase Xerox machine. That Xerox machine what you have purchased, you have not purchased with an intention to sell it to the customer. You have purchased with an intention to use it in the business. Let's say you purchase some furniture, not for the purpose of resale to customer, for the purpose of using in the business. Then it is going to be called as an asset. If it is bought with an intention to resell to customer goods, with an intention to use it in the business, we call it as an asset. So goods means anything which is bought or kept in the business with an intention to resell to the customer. Let's take an example. Let us say you want to buy an AC. Will you go to AC restaurant to buy it? No. You can't say that what, sir, in AC restaurant we'll find AC, so we'll buy the AC from there. No. The restaurant manager will tell, sir, we have not kept with an intention to sell. We have kept with an intention to use it. So that AC is not an goods for us. It's an asset. We have kept it for the use. So we are not going to resell to the customer. Suppose if you go to the electronic shop, Reliance Digital or Chroma Center or something like that, they have kept the AC with an intention to sell. For them it's a goods. They are going to resell to the customer. So anything which you have kept or bought with an intention to resell, it is going to be called as goods. Now you have to understand that whenever there is any transaction which is relating to goods, any type of transaction, for example, goods bought, goods are being sold, goods are being returned, any type of transaction relating to goods has to be recorded in the books of accounts by using only the following terminologies, only following names you can use if any transactions relating to goods. If there is any transaction relating to goods, terms like goods or name of the product is not used to record the transaction. So whenever you record the transaction relating to goods, you cannot write the name called as goods or name of the product, pen, pencil, marker, duster. You cannot use it. Instead of that, you have 4 names. Out of that 4 name, you have to use the suitable name. See, what is that? If you buy the goods from supplier, you are buying the goods from the supplier, then you write the name called as purchase. If you buy the goods from supplier, you write the name called as purchase. Now, whatever the goods you buy from the supplier, some of the goods are defective. Then you will return back that goods to the supplier. If you are returning the goods to the supplier, then we use the name purchase return. Let us say you have sold the goods to the customer. If you have sold the goods to the customer, if you sell the goods to the customer, then use the name called as sales. Now, what are the goods you have sold to customer? Assume that some of the goods are defective. If some of the goods are defective, customer is going to return back the goods to us. Customer is going to return back the goods. If goods are being returned by the customer, then use the name called as sales return. So be careful, these 4 names are applicable only if you are talking about the goods, only if you are recording the transaction relating to goods. Anything other than goods cannot use these 4 names. These 4 names are only applicable if you are recording transaction relating to goods. And be clear, don't use the name called as goods or name of the product to record the transaction relating to goods. Yes. Now doubt will arise, sir, how to record the transaction relating to asset? If there is any transaction relating to assets, to record such transaction, we need to use the name of such particular asset. Use the name of that particular asset. Use the name of such particular asset to record the transaction. If any transaction is relating to which one asset. So other than goods, actually goods is also a type of an asset only, because asset will give benefit in future. Even goods will also give benefit in future. If you sell the goods, you will get money. So whatever the goods you are holding in your hand, it is still unexpired. In future, if you sell it, you'll receive some benefit out of it. But I'm not talking about the which one goods. I'm talking other than goods. Other than goods, if any transactions relating to which one asset. Then to record such transaction, for example, furniture, land and building machinery, you buy the furniture, you sold the furniture, you return back the furniture. In all these cases, you need to use the name of such asset, for example, furniture, land and building machinery, to record the transaction. Hello everyone. So now we are going to discuss about concept number 5, cash transaction and credit transaction. It is important to differentiate which transactions are cash transaction and which transactions are credit transaction, because whenever you record the transaction in the books of accounts, whenever you record the business transaction in your books of accounts, you need to know whether they are cash transaction or credit transaction. Based on that only, we will record the transaction in the books of accounts. So first we'll understand what you mean by cash transaction. Cash transaction means settlement of money is done immediately. Money is being paid or received immediately. Is called as cash transaction. Let's say I sold the goods to the customer and I collected the money from the customer immediately. Let it be through cash or through Google Pay or Phone Pay, I received the money from the customer. So whenever I receive the money from the customer immediately, it is called as cash transaction. Let's say I purchase goods from the supplier and I paid money immediately to the supplier. So it is called as cash transaction. Now understand what is a credit transaction. We purchase the goods from supplier on credit and we promise to the supplier to make the payment in future. So whenever the payment of money or receipt of money is postponed to a future date, then it is called as credit transaction. So I purchase the goods from supplier on credit and I'm promised to pay in future, then it is called as credit transaction. Or let's say I sold the goods to the customer on credit and customer is telling that I'll pay the money in future. So no money is being exchanged now. Money is going to be received in future. Then it is called as credit transaction. So if immediate settlement of money is being done, then it's called as cash transaction. Suppose if the settlement of money is being postponed to a future date, then it is called as credit transaction. Now understand, whenever there is a cash transaction, name of the party, name of the customer or name of the supplier or name of the person is not required. Name of the person or party is not required if it is a cash transaction. Let us take an example. Let us say there is a person called as Chintu. Chintu go to a particular shop and he asks for a chocolate of 10 rupees. He buy a chocolate of 10 rupees. So what will happen? Chintu is going to pay the which on cash 10 rupees to the shopkeeper and shopkeeper is going to give the chocolate. But before giving this chocolate, is the shopkeeper is going to ask the name of the customer? No. Shopkeeper will not ask the name of the customer. Why shopkeeper wants the name? Why he wants to remember his name? Because you have received the money and you are giving the product. So there is no requirement of the which one name of the party. So name of the party or person is not required. If it is which transaction? Cash. Suppose if it is credit transaction, then name of the party is going to be necessary. Suppose if it is credit transaction, name of the person will be necessary. So let us say Chintu goes to the shopkeeper and he asks for a chocolate of rupees 10 and he promises to pay this money in future. He will tell to the shopkeeper, I don't have money now, I'm going to pay after 2-3 days. Now what will happen? Shopkeeper will ask the name of the customer. Before he gives the product or chocolate to him, the shopkeeper will ask what is your name. Why? Why name is necessary? Because the shopkeeper has to remember from whom, from which customer he has to collect how much money. Because a shopkeeper will be having so many customers from whom he has to receive the money. So he has to remember from which particular customer he has to receive how much money. So in short, whenever there is credit transaction, name of the person is necessary. Or you can say whenever you record credit transaction, then name of the person will also be recorded. But whenever there is cash transaction, name of the person will not be recorded in the transaction. So name of the party not necessary to record a transaction if it is cash transaction. But name of the person is necessary to record a credit transaction. Yes. Now you understand how to classify the transaction into cash and credit. Let's say they are given a particular transaction to you. You need to classify it. Is it a cash or is it a credit transaction? So for that, you need to understand this rule. First, you find in the transaction given in the question, name of the party. Name of the party. Is it being given in the transaction or is it not given in the transaction? Suppose if the name of the person is not given in the transaction, then it is a which transaction? Cash transaction. If name of the person or party is not given, then obviously it is cash transaction. Why they have not given the name? Because it's a cash transaction. That is the reason they would have not given the name of the person. So whenever the name of the party is not given in the transaction, it is a cash transaction. For example, goods sold rupees 16,000. They have mentioned goods sold rupees 16,000. Have they given the name of the person or name of the customer or name of the party? Answer is no. Why they would have not given? Because it is which transaction? Cash. So whenever no name is given, you should take it as which transaction? Cash transaction. So here there are some examples. That is transactions relating to the which one? Sale of goods. So this all transaction we need to classify which all are cash and which all are credit. So this particular transaction is a cash transaction. No name of the person is given, then it is a cash transaction. Now next one. Suppose if the name of the party is being given in the transaction, name is being given, then you check along with the name, is it mentioned that cash is being settled, cash is being paid or cash is being received? They are given the name. Along with name, they have told that cash is being paid or cash is being received, cash is being settled. Then also it is a cash transaction. Along with name, if the cash is being settled given, then it is cash transaction. See for example, goods sold to Priya on cash. They have given the name of the person and along with that they mentioned that cash is being settled. Then this is also called as cash transaction. Next, suppose name of the person is being given but nothing is mentioned about the cash is being settled, nothing is told about cash is being paid or received, just name of the person is given without mentioning that cash is being paid or cash is being received, then you take it as credit transaction. Only name is given without cash is being settled, anything relating to that cash is being settled is not given in the question. Then it is which transaction? Credit transaction. See for example, goods sold to Priya. They have given the name of the person. They have not mentioned that what cash is being settled, not settled, nothing is told. Then it is which transaction? Credit transaction. So how do we understand? If the name of the party not given, then it's a cash transaction. If it is given and along with that they have told cash is being received or paid, then it's a cash transaction. If only just name is being given, nothing is told about cash is being settled or not, then it is credit transaction. Now let us see few examples and let us try to classify into cash and credit transaction. Cash sales. Here name only say cash sales, so it is a cash transaction. Next, goods sold for cash. Here also they themselves has mentioned sold for cash, so cash transaction. Goods sold to Priya on credit. We have sold goods to Priya on credit, so they mentioned sold on credit, they themselves mentioned, so it's a credit transaction. Goods sold on credit. Here they only mentioned goods sold on credit, so again this is also credit transaction. Yes, so first three transactions are cash transaction. To record this transaction, sorry, first four transactions are cash transactions, and to record this first four transaction, no name of the person is required. But to record the credit transactions, these three transaction, name of the person is compulsory. Here we know the name of the person Priya. Here also we know the name of the person Priya. But this transaction, there is no name of the person. We don't know the name of the person. But to record credit transaction, name is compulsory. But here, name of the person we don't know. So whenever there is a credit transaction, and if you don't know the name of the person, name of the party, if it is missing in the question, if it is not given, then you should use some common names, some general name, some common names to record that credit transaction, to record the name of the party. Some common names you should use. So if you don't know the name called as Priya or name of the person in this particular transaction, then instead of Priya, you can use the name called as debtor. Debtor means a person to whom we have sold the goods on credit. Customer. Customer is called as debtor. A person from whom we have to receive the money because you have sold the goods on credit. So whenever there is a credit sale of goods, goods sold on credit, but you don't know the name, then use some common name, some general name, debtors, or you can say trade receivables, or you can say customer account, trade receivable account, or debtors account. Suppose you purchase goods on credit, but you don't know the name of the supplier, then you can use the name called as creditors. Creditors means supplier of the goods to whom we have to pay the money, or you can say trade payables or supplier account. So whenever there is credit transaction but name of the party is missing, then you should use some common names, general name. For credit sales, debtor, trade receivable, or customer. For credit purchases, creditors, trade payables, or supplier. Any of the name you can use it. Hello everyone. So now we are going to discuss about how to do the recording of business transaction. Sale of goods, purchase of goods, shop rent paid, electric charges paid. All these are business transactions. So we need to record it in the books of accounts. So books of account means a set of books which are being maintained to record the business transaction. In that set of books, one of the book is going to be called as journal. So every business transaction for the first time, every business transaction is to be recorded in a book that is called as journal. So in journal, whatever the transaction we are going to record it, that is going to be called as journal entry. So every business transaction for the first time, it will be recorded in a book that is going to be called as journal. And what are the transaction we have recorded, what are the entry we have recorded in that book, that is going to be called as journal entry. Sir, what do you mean journal entry? A systematic way of recording the transaction. A proper way, a systematic way of recording the business transaction is called as journal entry. See, you might have observed in case of some petty shops and all, small shopkeepers. Even those people also record. Even those people will record the transaction in a book, in small diary or in some notebook or something, they record the transaction. But the way what they record the transaction, that is unsystematic way. Everybody cannot understand what exactly they are trying to tell by seeing those transactions what they've recorded, because they have recorded in an unsystematic way, which is not universal, which is not being followed by everyone. Systematic means which is followed by everyone, universal. Everyone can understand that what exactly they are trying to tell by recording those transactions. So every business transaction for the first time, it will be recorded in a book called as which one? Journal. By passing an entry called as which entry? Journal entry. Journal entry is what? A systematic way, a proper way of recording a business transaction. Now listen. For example, let us say electricity charges paid 2000 rupees. I want to record it for the first time in a book called as what? Journal. So when you record the transaction in journal, every transaction should be recorded only based on supporting documents. By seeing that electricity bill, water bill, invoices, sales bill, purchase bill, we record the transaction. So if you want to record the transaction in the book called as journal, it should be based on supporting document. Supporting document means evidence of the business transaction. Purchase bill, sales bill, electricity bill, etc. Without a supporting document, without an evidence of a business transaction, a transaction cannot be recorded in the journal. So there is a rule which says that every transaction recorded in the books should be based on some evidence of business transaction. That particular rule is called as objectivity concept, or we can say verifiable objective concept. Objectivity concept or verifiable objective concept. See, there are two terminologies are there, two terms are there, subjective and objective. Subjective means based on opinion. Suppose if I ask you what is the price of this marker, different people will give different answer, because these are based on your opinions. This is called as subjective. But we don't record transaction in the books based on opinion. We record based on evidence. Suppose if I give the purchase bill, I purchase this marker from Apple store. What are the bill I received from them? If that bill, I will give it to you people. And by seeing that bill, if you tell what is the price of this Apple pencil, then everybody will give same answer, because you are giving the answer based on evidence, based on bill. That is called as objective. Objective means based on evidence. Subjective means based on opinion. So they say that if you want to record the transaction in the books based on evidence, you record it. It is called as objectivity concept or verifiable objective concept. Yes. So we understood that every transaction for the first time, it will be recorded in a book called as journal. And what are the entry we record? That is called as journal entry. Now we need to understand what are the rules for passing the journal entry. If you want to pass the journal entry, if you want to record the entry in the book called as journal, how do you record it? How you are going to pass a journal entry? Now listen. As we discussed earlier, every business transaction, for example, sale of goods for cash, you're selling the goods for cash. Then what will happen? Goods will go out of the business and cash will come into the business. So here two things are changing in the business. One is goods and the other one is cash. Whenever you pass a journal entry, first you find what two things are changing in the business because of that particular business transaction. Sir, what do you mean by two things are changing? Something will increase or decrease in the business because of the transaction. You sold the goods, so goods will decrease. You received the cash, so cash will increase. These are the two changes. Goods are decreasing and cash is increasing. So the two changes first you find out. Once you find out that two changes are goods and cash, then you find that which one is increasing and which one is decreasing. Which one is increasing and which one is decreasing. For example, here cash is increasing and goods are decreasing. Now to record how much cash has increased or how much goods has decreased. To record this increase or decrease, you use the word called as debit and credit. Debit credit is the alternative name for increase decrease. Instead of using the name called as cash has increased by this much or goods has decreased by this much, instead of that we use the terminology called as debit and credit. Name called as debit and credit. But don't think that debit means always increase. Debit is increase as well as decrease also. Credit means increase as well as decrease also. So when we should understand increase means debit or increase means credit, for that we have the rules for debit and credit. Now what that rules for debit and credit says, whenever asset or expenses increases, whenever asset or expenses increases, they say that we have to do debit. Asset expense increases, we should do debit. But whenever income liability capital, because of a business transaction, if you find that your income liability or capital is increasing, then you should do credit. But because of your business transaction, if asset or expense is increasing, then you should do debit. So rule is that asset expenses increases or created, whenever your asset or expense are increasing or it is created, then you should do debit. But for income liability capital, whenever the increases or created, we should do credit. Sir, what if it is decreased? Then you should do reverse, ulta. Increase debit, then decrease will be credit. Increase credit, then decrease will be debit. So what is the rule is, asset expense increases debit, decreases credit. Income liability capital increases credit, decreases debit. Now one doubt will arise, sir, what exactly this debit and credit is? Why they are using the two names? One debit name, one credit name and all. Now see, listen. Just one example I'll give you. Let us say in your business, multiple times inflow of cash will happen and multiple times let's say outflow of cash will happen. So money will become inflow multiple times and outflow multiple times in a day. Now to record how much money came in and went out, you have two approach. One, what you do, you take one sheet of paper and just in one column you record inflow also, you record outflow also. Let's say inflow 1000, outflow 800, so net 200 cash is left out. This is one approach. Or else what you can do, you take one sheet of paper, there we write as cash. This is also cash only, here also I'm recording cash transactions only. Inflow and all you write on the one side and outflow you record on the other side. So you make two sides. One is right hand side and one is left hand side. If anything increases, you write it on one side. If anything decreases, you write on the other side. Let's say cash came 1000 rupees. Cash went out 800. So came 1000, went out 800. So left out is 200. This is second approach. So if you observe these two approach, more comfortable, better way of understanding is second approach. Increase all on one side, decrease all on the other side. So these two sides are called as debit and credit. These two sides itself is called as debit and credit. This left hand side is called as debit side, and this right hand side is going to be called as credit side. So debit and credit is two sides of a single page. One is debit and the other one is which one? Credit. So what is the rule is for asset expenses? For asset expenses, for example, let us say cash. We know cash is an asset. So debit and credit. For asset expense, what is the rule is if it increases, you do debit. If it decreases, you do credit. This is the rule for asset expense. But whenever you are talking about income, liability or capital, for example, bank loan is a liability. We taken loan from the bank, it's a liability. So when liability increases, you write on the credit side. But when it decreases, you write on the debit side. And if you remember, in earlier class we discussed that asset expense comes under the same category because there is an outflow of money. Income, liability, capital comes in the same category because there is an inflow of money. That is the result. That is the reason there is same rule for asset expense and same rule for which one? Income, liability, capital. Income, liability, capital one rule, asset expense one rule. So I hope you have understood this rules for passing the journal entry. Yes. So now we are going to discuss about concept number 7, how to pass the journal entry. We know that every business transaction for the first time, it will be recorded in a book called as journal. And we record the transactions in a systematic order, in a particular order, in a particular format. So let us first try to understand the which one format of journal. So totally 5 columns are going to be there in journal. First one is called as date, that is date of transaction, when that particular business transaction has taken place. The date on which the transaction is occurred, that date we are going to write, that is date of transaction. Next, particulars, where we are going to pass the journal entry. Next, ledger folio. Folio means page number of the ledger. This particular transaction will be transferred to one more book, next book, that is called as ledger. For the first time, every transaction will come to journal. From journal, it will be transferred to the ledger, the second book. So in which page number we have recorded this transaction? In the ledger. That is going to be written in the LF column, ledger folio column. Suppose if it is transferred to page number 40 of the ledger, then we write here page number 40. Then we have two columns, debit amount, credit amount, two columns, one to record debit amount and one to record credit amount. So totally 5 columns are there. Date, particulars, ledger folio, debit and credit. Let us just take an example of any one particular business transaction to understand the journal entry. Assume that on 10th April, we have paid salary in cash. We paid salary to our employees. That's a 12,000 rupees paid in cash. Then the journal entry will be salary account debit to cash account. So salary account debit 12,000 rupees. The first line is called as debit line. In this journal, whatever this first line is there, this is called as debit line. And here DR means debit recorded. And CR means credit recorded. So we are going to record debit as well as credit. So salary account debit, this first line is going to be called as debit line. Now when you are going to record the credit, first you need to leave some space. Leave some space, then we start with 2. Whenever we record the credit, first we are going to start with a word called as 2. 2 cash. This second line is going to be called as credit line. So in the journal you have two aspects. One is debit, one is credit. This is debit line, this is credit line. Yes. How this journal entry came, that we are going to see later on. How this particular journal entry came, that we are going to see later on. Just I am telling one example, format, to explain the format. So whenever I say that this particular account should be debited, it means you should write in the first line. When I say it should be credited, then you should write in the second line. Now below this journal entry, we are going to write narration. Narration means a short explanation of the business transaction. Whatever this journal entry we have passed, we give a short explanation of this. Because many a times what will happen, even if the business transaction is different, the journal entry is going to look similar. Let's say there are 4 different types of business transactions are there. But in all the 4 business transaction, let us say journal entry looks similar. Same kind of entry or similar kind of entry it is going to look like. So to avoid that confusion, for which particular transaction, which entry it is, to avoid that confusion, what we do, we write a short explanation of that particular transaction. So narration means a short explanation of business transaction written under each journal entry. And whenever we write the narration, we start with a word called as being. We start with a word called as being. Being salary paid in cash, being goods sold for cash, being goods purchased for cash, being electric charges paid, being amount paid to creditors, supplier of the goods. So whenever we write narration, we start with a word called as being. So what is the format of journal entry? Totally 5 columns. First column is going to be called as date. Next one is called as particulars, where we are going to write journal entry, and below each journal entry we are going to write the narration. Ledger folio, page number of the ledger, debit and credit, debit amount and credit amount. Yes. Now we take an example and we'll pass the journal entry for the transactions. So journalize the following transactions. So now we are going to study how to pass the journal entry. Okay. So see the example. On 1st April 2017, business started with cash of rupees 1,50,000. On 1st April, we started business with a cash of rupees 1,50,000. Now we know that a person who is going to start the business is going to be called as owner. So owner has started a one particular business with cash of rupees how much? 1,50,000. So owner has introduced money into the business. He has invested money into the business. And how much amount of money he has invested? 1,50,000 rupees he has invested in the business. As we know that whenever we do accounting, we always think from business point of view. You always and always think from whose point of view? Business point of view. What is coming into business? What is going out of the business? So you need to think from business point of view. What is happening in the business? So you know that when cash is being introduced into the business, cash will come into the business. Now, whenever you pass journal entry, first you need to find what two things are changing in the business. As I mentioned you, as per dual aspect concept, every transaction, every business transaction will make two changes in business. First you identify the two changes. So in this, two changes are, first is cash, because cash is going to come into the business. So cash is going to change in the business. Now whatever the money the business has collected from the owner, business is liable to repay in future. It's an obligation of the business that it has to repay in future. So that money what business has to pay to the owner in future is called as capital. Capital means amount invested by the owner into the business. So because of this transaction, two things are changing in the business. One is cash is increasing in the business. And who has invested this cash? Owner. So business is liable to pay back this money to the owner in future. So business has to record that this much of money I need to pay to the owner in future. So what are the money they need to pay? It is called as capital. So here only two things are changing. One is cash and next one is what? Capital. So first we found out the two changes. Next what we need to do, whatever these two things has changed, cash and capital, you need to find, is it an asset, is it an expense, income, liability or capital? You just need to match what these two things are out of these five terms. Is it asset, expense, income, liability or capital? Now cash, just assume that you have plenty of cash. Cash is an asset. See, listen, either cash is coming into business, going out of the business, doesn't matter. You know, cash is an asset. Is it coming in or going out? It will be an asset only. So you have plenty of cash available with you. Or cash, we know that it is an asset. Next, capital is capital itself. Out of that five terms, capital is capital. Next, now you check these two things. Are they increasing or decreasing? So we know that when cash comes into business, cash will increase. Asset is increasing by 1,50,000 rupees. And even capital is also increasing. Earlier capital was 0. Now owner has invested 1,50,000. 0 plus 150. So capital is also increasing. So in this, both the things are increasing. Cash is also increasing and even capital is also increasing. So totally three things we have done till now. What three things? First, identify two changes in business due to the business transaction. What two things are changing? First you find out that. One is cash and one is capital. Next, what are the two things have changed? Cash and capital. You just match it. Is it an asset, expense, income, liability or capital? We know cash. Cash is an asset. Be careful. Let cash go out of the business, come into business, doesn't matter. Cash is always an asset only. Furniture, let it go out or come in. It's an asset only. Machinery, let it go out or come in. Increase or decrease. It's always an asset. So, cash is what for us? Asset. And capital is capital. Next, what you have to do is find those items. Are they increasing or decreasing? So, we need to check because of this transaction. Cash and capital, have they increased or decreased? Cash also increased, capital is also increased. Now, last, what you need to apply the rule for debit and credit. What a debit credit rule is there? Apply it and you will get the final answer. Apply debit credit rule for final answer. Now, what is that rule we discussed? Due to any business transaction, if asset is increasing or expense is increasing, then we should do debit. So here asset is increasing, so we have to do debit. It means cash account will be done debit. Next, capital. Whenever income, liability, or capital increases, we do credit. So capital increases, what we do? Credit. So it means that cash should be done debit and capital has to be done credit. So the journal entry will be cash account debit to capital account. Debit 1,50,000 and credit 1,50,000. So cash we are going to do debit and capital we are going to do credit. Narration. Narration will be being capital introduced. Yes. Let us take second example. On 1st April 2017, goods purchased from Manisha. We have purchased the goods from Manisha. So if you remember, we discussed that whenever in the question only name of the person is being given, only name of the party or name of the person is being given, and nothing is mentioned regarding cash is being paid or cash is being not paid, nothing is told, then it is going to be a credit transaction. Whenever only name is being given in the transaction without mentioning anything about the cash being paid or not, then it is called as which transaction? Credit transaction. So we have purchased goods from Manisha on credit. We have not paid the money. We are going to pay the money in future. How much amount? 36,000. Again. For this again we'll find what two things are changing in the business. First, think from business point of view. Always think from business point of view. If you purchase the goods, goods will come into the business. Goods will increase in the business. So first thing is what? Goods. Next, whatever this 36,000 of goods we have purchased, we have not paid money for this. We are going to pay the money in future. Amount payable in future is your obligation. You have to make the payment of this money in future. Amount payable in future is called as liability. So goods are increasing. Along with that, you have not paid the money. Because of that, what will happen? Your liability will increase. You need to record a liability in your books by 36,000. So one more change will be we record a liability and name of the liability is going to be called as Manisha. So here two things are changing. One is goods, the other one is Manisha. First, goods is an asset out of that five terms. Assume that you have plenty of goods available with you. 10 lakh or 20 lakh or 30 lakh rupees of goods are available. Goods is an asset for you. And when you purchase the goods, goods will increase. Goods will come into the business, goods will increase. But have you paid the money? No, you have to pay the money in future. So it's a liability. You have to record a liability in your books because you have to make the payment in future. So you have to create a liability. Creating a liability means increasing a liability. Either you say that you record a liability, create a liability, or increase liability, all are same. So asset is increasing. We do debit. Asset increases, we do debit. Liability increases. Liability increases, we do credit. So debit will be goods and credit will be Manisha. So goods account debit to Manisha. 36,000. 36,000. Goods account debit and Manisha account credit. we discussed one more thing. If there is any transaction relating to goods, you cannot write the name called as goods or name of the product. Instead of that, you have to write any of the four suitable name. So we discussed that whenever you buy the goods from the supplier, we have to write a name called as purchase. We are buying the goods from Manisha, supplier of the goods. We are buying the goods. So here we cannot write the name called as which one, goods. Instead of goods, the suitable name is going to be purchase. So the correct journal entry will be purchase account debit to Manisha. Purchase account debit to Manisha. This is your correct entry. Don't write the name goods, instead of that purchase. So narration will be being goods purchased on credit. So for narration, there is no problem. You can write in your own language. So there is no straightforward rule says that you have to write like this only. Only thing is you need to start with a word called as being. Goods purchased on credit. Yes. So see the next transaction. On 2nd April, we have opened a bank account with State Bank of India. We have opened an account with SBI by depositing for rupees 35,000. So you know that whenever you open a bank account, you have to deposit the money into bank account. Some cash you need to deposit into bank account. So we have opened a bank account by depositing how much rupees cash? 35,000. Now think from business point of view. When you deposit the money into bank account, when you deposit the cash into bank account, what will happen? Your cash balance will decrease. First, what change will happen? Cash. Cash is going to decrease in the business. Once you deposit the money into bank account, your bank balance will increase. So bank balance is going to increase. So here two changes are happening. One is cash is decreasing, cash is going out, but bank balance of the business will increase. Yes. Now we know that cash balance is an asset and even bank balance is also an asset. Cash comes into business, goes out of the business, increases, decreases. Doesn't matter. Always cash is an asset only. Bank balance is also an asset. So cash is also an asset. Bank balance is also an asset. Now what the rule says, whenever asset increases, we do debit. So bank balance is increasing, we do debit. Next, whenever asset decreases, so here asset is decreasing, asset decreases, we do credit. So asset increases, we do debit. So bank account will be debit. $35,000. Next, cash will be done credit. So to cash account. 35,000. So narration will be being opened a bank account. Being opened a bank account. See the next transaction. On 2nd April, goods sold to Priya. We have sold goods to Priya. So as I mentioned, whenever in the transaction, only name of the person is being given, name of the party is being given. And they have not told anything about cash is being settled or not, cash is being received or not. If only name is being given, then it is a credit transaction. Here we have sold goods to Priya on credit. We have sold the goods to Priya. We have not collected the money. We are going to receive it in future. So goods sold. Think from business point of view. If you sell the goods, goods will go out of the business. So first, what is going to change in the business? Goods. Goods are going to decrease. Goods will go out. You are selling the goods. Have you received the money? No. But you are going to receive in future. Money receivable in future, amount receivable in future is an asset. But amount payable in future is a liability. If you have to pay in future, it's a liability. But you have to receive in future, then it's an asset. So you have to receive the money from Priya. So you have to remember, from this particular person, I have to receive the money. So you create an asset. In your books, you create an asset by the name called as Priya. Creating an asset means increasing an asset. Creating an asset or increasing asset, both are same. So two changes are happening. First is what? Goods. We know that goods is an asset. And one more change is Priya. We have to create an asset in the name called as Priya. So asset increases, we do debit. Asset increases, we do debit. Asset decreases. Asset decreases, we do credit. So debit will be Priya and credit will be goods. So Priya account debit 16,000 to goods account 16,000. Priya account debit and credit will be goods. But we remember that whenever we do transaction with respect to goods, we use that four terms, four names. Out of that, suitable name is sales. Whenever we sell the goods to customer, we write the name called as sales. So instead of goods, we have to write the name called as sales. So correct entry will be Priya account debit to sales account. Priya account debit to sales account. So narration will be being goods sold to Priya. Priya account debit to sales account. Don't use the name goods and all. Instead of that, that four suitable name. Any name is suitable, that you have to use it. Yes. Now see the next transaction. On 3rd April, received a check of rupees 16,000 from Priya. We have received the check from Priya. So see here, Priya was supposed to give the money to us. 16,000 because we have sold goods on credit. So that money she gave on 3rd April. So we received a check from Priya rupees 16,000. Once you receive the check, you are going to deposit that check into bank account. So once you receive the check and deposit into bank account, your bank balance will increase. Once bank will collect the money on that check, your bank balance will increase. So first change is what? Bank balance is an asset and it is increasing. See the next change. See, earlier you have recorded an asset called as Priya in your books. You have created an asset in your books in the name of Priya. Once you collect the money 16,000, that asset will get reduced. Priya's asset balance will get reduced from 16,000 to 0 because you have collected the money. Once you have collected the money, Priya balance has to become 0 in our books because you have collected the money. So in our books, there is an asset called as Priya, which you have recorded as an asset. Once you receive the money, the balance will get reduced. So first one is bank balance, which is increasing, and whatever the asset we have recorded, we have to reduce it to 0 as we have collected the money. Asset increases debit. Asset increases debit. Next, asset decreases. Asset decreases, credit. So debit will be bank, credit will be Priya. So the entry will be bank account debit to Priya account 16,000. Bank account debit to Priya 16,000. Being check received from Priya. Being check received from Priya. See the next transaction. On 5th April, sold goods to Nidhi. They have just given the name of the person. They have not told that cash is being received. Just we have sold the goods. It means it's a credit transaction. Only name of the person is given without mentioning about the cash is being settled. Then it is a credit transaction. Sold goods. If you sell the goods, first what will happen? Goods will decrease in the business. Always think from business point of view. Goods will decrease. Goods is an asset. Asset is decreasing. Have you received the money? No. You are going to get the money in future. Money receivable in future is an asset. If you have to receive money in future, it's an asset. So from whom we have to receive the money? Nidhi. So in our books, we create one asset called as Nidhi. Creating means increasing an asset. So when you create an asset called as Nidhi, you have to remember that from whom you have to receive the money. So create one asset in your books. Create an account in your book by the name Nidhi. So that you remember from whom you have to collect the money. So asset increases, we do debit. Asset increases, we do debit. Next, goods is also an asset. It is decreasing. Asset decreases, we do credit. So debit will be Nidhi. Credit will be goods. So Nidhi account debit 14,000 to goods account 14,000. As we know that we cannot write the name goods. As we are selling the goods to the customer, we are selling the goods. So we use the name called as sales. So the correct entry will be Nidhi account debit to sales account. Nidhi account debit to sales account. So narration will be being goods sold to Nidhi. So whatever this 14,000 of goods we have sold on credit, we have received the money from Nidhi. On 8th April, Nidhi pays 14,000 rupees cash. So whatever the asset we created in the name of Nidhi, so Nidhi, from Nidhi we have collected the money now. Nidhi has paid the money to us, 14,000 cash. So when you collect the money in the form of cash, first cash is an asset. It is going to increase. In your books, you have already recorded one asset in the name of Nidhi. You have recorded an asset in the name of Nidhi by 14,000. Now that 14,000 will become zero because you have collected the money. Reduce the balance. So in your books, you have recorded Nidhi as an asset. So you need to decrease it. Asset increases. Debit. Asset increases, we do debit. Asset decreases, we do credit. So cash account will be debit and credit will be Nidhi to Nidhi account. So cash account debit to Nidhi account 14,000. Yes. See the next transaction. 10th April. Goods purchased for rupees 20,000. We have purchased goods of rupees 20,000 on credit from Ritu. We purchased goods on credit. So when you purchase the goods, think from business point of view. Goods will increase. Goods is an asset. Asset increases. But have you paid the money? No, we are going to pay the money in future. Money payable in future. Money payable in future is going to be called as liability. If you have to pay any money in future, it's a liability. So we have to create a liability in our books by the name called as Ritu, because we have to pay the money to Ritu. Creating a liability means increasing a liability. So we have to create asset and we have to create liability. So whenever you purchase the goods, goods increases, asset increases debit, and liability increases credit. So asset increases debit, liability increases credit. So your debit will be goods. So goods account debit. Credit will be Ritu to Ritu account 20,000. But we know that we cannot write the name called as goods. As we are buying the goods, we are purchasing the goods, buying the goods. So we write a name called as purchase. So purchase account debit to Ritu account. So narration will be being goods purchased on credit. Being goods purchased on credit. So correct entry is purchase account debit to Ritu account. See the next transaction. 14th April. Insurance paid. Insurance premium. Insurance premium paid is an expense. We paid an expense by check. How much rupees? 6,000. Now one important line you remember. Whenever you pay any kind of expenses, whenever you pay, whenever you are going to pay any kind of expenses, whenever any kind of expenses is being paid, you need to create an account called as expense account in your books. You need to create an account called as expense account in your books. And whenever you are going to receive any type of income, you create an account, income account in your books. So what you have to remember, whenever there is any type of expense being paid, you create an account called as expense account in your books, because you need to know what all expenses you have paid. So you have to create that account in your books. You have to record expense in your books. And whenever you receive any kind of income, create an income account. Record income account in your books. So see here what happened. Expense is being paid by check. Insurance premium paid by check. So think from business point of view. You're paying the expense. Insurance premium is an expense. So first you create an expense account called as insurance or insurance premium. So first we need to record insurance account or insurance premium account. It's an expense. So first we need to create that account. Create means increase an expense called as insurance premium. Because at the end of the year, if you want to know how much profit or loss is made in the business, you need to know the list of incomes and list of expense. So if you have not recorded which all expense you have paid, which all incomes you have received, then how you find profit or loss at the end? So create that account in your book called as expense account. Now you know that you have paid the money by check. So if you have paid the money by check, bank balance will reduce. So if you make the payment through check, your bank balance will reduce. We know that bank balance in asset decreases. So create an expense. Because you paid the money through check, your bank balance will decrease. Whenever we create an expense, whenever expense is increased or created, we do debit. And whenever asset decreases, we do credit. So debit will be insurance premium. And credit will be bank account. Insurance premium account debit or insurance account debit to bank account. Amount is 6,000. Being insurance premium paid 6,000. Being insurance premium paid 6,000. Yes. See the next transaction. 18th April. Paid rent rupees 2,000. You paid shop rent, business rent, the premises where you are conducting the business operations. For that premises, you have paid the rent. So whenever you pay any type of expenses, first create the expense account. First, we'll create the expense account. So rent is an expense. You create it. Creating means increasing. So first you create an expense account called as rent. Now you have paid this money 2,000 rupees. So whenever you pay the money, money will go out. Cash will go out. Assume that this 2,000 is paid by cash. So if you have paid this 2,000 by cash, cash will decrease in the business. So cash is an asset. Asset decreases. We do credit. So expense increases. Expense increases, we do debit. Asset decreases, we do credit. So asset decreases, we are going to do credit. So debit will be rent. So rent account debit 2,000 to cash account 2,000. Rent account debit to cash account 2,000. Being rent paid. So whenever you are paying any type of expenses, create an expense, increase an expense, create an expense account. And whenever you receive any income, create an income account. So see the next example. On 24th April, we purchased office furniture for rupees 11,200. We purchased office furniture for 11,200 rupees. If you see in this transaction, no name of the party is given. Why they have not given the party? Because we have already paid the money. When you have already paid the money for purchase of furniture, why you need to remember the name of that supplier of furniture? So furniture purchased, no name of the party is given. It is always a cash transaction. So think from business point of view. If you have purchased the office furniture, so first what will happen? Furniture will come into the business. So furniture is going to come into the business. So furniture is an asset. Asset increases. We do debit. Asset increases, we do debit. You have paid money. Let us you have paid money through cash. So cash is also an asset. And asset decreases, we do credit. Asset decreases, we do credit. So entry will be furniture will be debit. Cash will be credit. Furniture account debit to cash. 11,200. Narration being furniture purchased. Be careful. Whenever you buy any asset, whenever you buy anything other than goods, if you buy the goods, if you purchase the goods, then you should record it as a purchase. You're not buying goods over here, you're buying an asset. So if any transaction is relating to asset, we should record the transaction by using the name of the asset. So name of the asset is furniture, you just write furniture, don't write purchase. Purchase you should write when you buy the goods. Yes. See the next transaction. On 29th April, cash withdrawn for household expenses, for household purpose, rupees 5,000. See, who has the right to, who can withdraw the money from the business? Obviously, owner. An outsider can never withdraw the money from the business. So obviously, owner is withdrawing the money from the business. So he's taking the money from the business. So cash is decreasing in the business. Cash is an asset. It is decreasing. Asset decreases credit. If you take the money from the business, so money will decrease, cash will decrease in the business, asset decreases credit. Now whatever the money the owner has taken from the business has a right to receive that money from the owner. So business have a right to receive, it means it's an asset. Business has a right to receive this 5,000 rupees from owner in future. So it's a right to receive. Right to receive means what? Asset. So what the business will do? Business will create an asset in its book by the name called as drawings. By the name called as drawings. Drawings means whenever owner withdraw goods from the business or cash from the business or asset from the business, whenever owner takes any goods from business, cash from business or asset from business for his personal use, for his personal use, then it is recorded in the books by the name called as drawings. Drawings means cash, asset or goods owner has withdrawn from the business, taken from the business for personal use, then that is going to be called as drawings. So here what has happened? Cash is withdrawn from the business. So cash will decrease, asset decreases, credit. But business has a right to receive that money from the home owner. So business has to create an asset in the name called as drawings. In the name called as drawings. Drawings means that much money business has to receive from the owner because he has taken that much of money for his personal use. Capital means business has to pay that money to the owner in future. Business has to pay is called as capital. Business have a right to receive is called as drawings. So right to receive means asset. To create an asset, to increase an asset, we are going to do debit. So debit will be drawings. So drawings account debit. Credit will be cash. To cash account 5,000. So entry is drawings account debit to cash account. Drawings means personal expenses. Money withdrawn for personal expenses called as drawings. Yes. See the next transaction. On 30th April, interest received. Let us say we have done some fixed deposit. We have deposited some money in the savings account or fixed deposit of the bank. On that, we are going to receive the interest. Interest received is an income. Interest received is an income. Or let us say you have given some loan to your friend. On that, you are going to receive the interest. It's an income for you. Interest received is an income. Yes. So as I mentioned you, whenever you are going to receive any kind of income, whenever you're going to receive any kind of income, you need to create an asset in your books. Sorry, not an asset. You need to create an income in your books. So whenever you receive any type of income, you need to create an income account. So interest received is an income for you. So first you create an income called as interest received. Creating means increasing. So to increase an income, to create an income, we do credit. Interest received is an income. Whenever you receive any type of income, that account should be created. Whenever you pay any expenses, that account should be created. Expense account and here income account. So we do credit. Now what are this interest is there? You have received in cash. So cash will increase in the business. Cash is an asset. Asset increases. Asset increases. We do debit. So cash is an asset. Asset increases. We do debit. So cash account debit 1,200. Interest received is an income. And to create or increase the income, we do credit. So to interest received 1,200. Cash account debit to interest received. Narration. Being interest received in cash. Cash account debit to interest received. Huh. Narration for previous transaction. Being cash withdrawn for personal use. Being cash withdrawn for personal use. See the next transaction. On 30th April, cash sales. Cash sales means goods sold for cash. So think from business point of view, if you sell the goods for cash, first cash will come into business. Cash is an asset. Asset increases, we do debit. Goods will go out. Goods is also an asset. Goods goes out, goods decreases. Asset decreases, we do credit. So asset increases debit, asset decreases credit. So debit will be cash and credit will be goods. $2,300. Being goods sold for cash. But we know that whenever we sell the goods, we don't write the name called as goods. Instead of that, we are going to write sales account. We are selling the goods to customers, so we write sales account. So cash account debit to sales account. Next, 30th April. Commission paid. Commission we have paid to our agent or to our employees. We have paid commission by check. Commission is an expense. Whenever you pay any type of expenses, first you create expense account. Whenever you receive any kind of income, first you create the income account. So commission paid. Commission is an expense. So first we create an expense. We do debit. To create or increase the expense, we do debit. Paid by check. You have paid the money by check. So money is going out. Bank balance will decrease. You have paid money by check, so bank balance will decrease. Bank balance is an asset. Asset decreases, we do credit. Asset decreases, we do credit. So commission is an expense, so we do debit. So commission account debit, or you can say commission paid account debit or commission account debit. Credit will be bank to bank account. 3,000. Narration. Being commission paid. Being commission paid. Next, telephone bill paid by check. Telephone bill is an expense. Telephone charges is an expense. So whenever you are paying expense, first create the expense account. Telephone charges account debit. Telephone expense account. So telephone expenses, telephone charges is an expense. And to create an expense, we do debit. To create an expense, to increase an expense, we do debit. And you have paid this money by check, so your bank balance will decrease. Bank balance of the business will decrease. Bank balance is an asset. Asset decreases, we do credit. asset decreases, we do credit. To create expense, we do debit. So telephone charges account debit to bank account 2000. Telephone charges debit to bank account 2000. Being telephone charges paid or being telephone bill paid. Next, payment of salaries. We are paid employees salary. Again same thing in cash. So first create an expense. Salary is an expense. To increase expense, we do debit. Next, we are paid in cash. Cash is an asset. So when you pay cash, cash decreases. Asset decreases credit. So entry will be salary account debit to cash account 12,000. Salary account debit, cash will be credit. Being salary paid in cash. See the next transaction. Stationery. Stationery means pen, pencil, marker, duster, calculator. Stationery purchased for cash. Now see, listen. Here we are going to learn one concept called as materiality concept. See, whatever the stationery you have purchased, for example, let us say you have purchased one sharpener. You have paid 10 rupees for that or 5 rupees for that. So whatever the 5 rupees you have paid for purchasing the eraser or sharpener, the benefit of that will not get expired in current year only. Because sharpener you can use for second year also, third year also, fourth year also. For example, eraser. Very rarely we use eraser in our office. But we have purchased it by paying 5 rupees. So it's not like full eraser will be consumed in current year only. That same eraser will be available for next year use also. Next to next year also. So here definition wise if you go, whatever this sharpener, eraser, scale and all you have purchased, it's like an asset. Because entire benefit is not being consumed in the current year only. Even at the end of the current year, that scale, eraser, calculator, it's still available with you. It can still be used in the next year. So it is not expired fully, it is unexpired. But in accounts now there is a concept called as a materiality concept. Materiality means significant amount. See, if amount involved in the transaction, if it is a very small amount, negligible amount, for example 5 rupees, 10 rupee, 20, 30, even by definition wise it's an asset. Don't consider it as an asset. Definition wise it is an asset because amount involved is very small. You don't treat as an asset. See, for example, let us say Reliance company. In the annual general meeting, he is addressing to the shareholders saying that Reliance company has an asset of sharpener, scale, pencil, eraser. It doesn't look good. So money involved is very small, negligible amount, small amount. So they say that for these small things and all, even it is unexpired cost, even amount is not fully consumed in current year, you treat as an expense only. You don't treat as an asset, you treat as an expense. So not shown as an asset, treated as an expense, whether consumed or not. That full eraser or sharpener, it is fully consumed or not consumed, doesn't matter, you treat as an expense. This is because of which concept? Materiality concept. Materiality means significant. Those things which impact the decision of the shareholders, of the investors, are called as significant, material. Those which doesn't matter much, those are called as insignificant, immaterial. So the stationery and all are small things, they're insignificant things. So don't treat as an asset, you treat as an expense. So stationery purchased for cash rupees 2200. So stationery, you need to record it as an expense. First you record the expense in the name called as stationery. So stationery account debit or stationery expense account debit. To create an expense, we do debit. And you are purchased by paying cash. So cash is an asset. Asset decreases, we do credit. Yes. So expense increases, we do debit. Asset decreases, we do credit. So debit will be stationery. So stationery account debit or stationery expense account debit. 2. Credit will be cash to cash account. 2200 being stationery purchased. Stationery account debit to cash. Okay. Just see the last one more transaction. Dividend received through check. Dividend received through check rupees 4000. What do you mean by dividend? Whenever you invest in the shares of a company, whenever you buy the shares of a Reliance company, Infosys, or any of the company, you are going to be called a shareholder of the company. So being a shareholder, whatever the profit the company is going to earn, a part of that profit they are going to pay to the shareholders. They are going to distribute among the shareholders. So profit distributed by the company to its shareholders, it's called as a dividend. So we have invested in shares of some company, we have received the dividend, we have received money, 4000 rupees through check. Dividend received is an income. So as I mentioned, whenever you are going to receive any kind of income, first you create the income account. Whenever you receive any kind of income, first you create the income account. Dividend received is an income. And to create an income or to increase an income, we are going to do credit. Income increases credit. And you have received this through check. If you have received this through check, you receive the check and you deposit into bank account. Your bank balance will increase. So business bank balance will increase. Bank balance is an asset. Asset increases, we do debit. Asset increases, we do debit. So entry will be bank account debit. And credit will be dividend received. To dividend received account 4000. Narration will be being dividend received. Being dividend received. Bank account debit to dividend received.